You know what nobody's talking about right now? The fact that gold holders just crossed into territory we haven't seen in decades. And I'm not being dramatic here. The data coming out of the major brokerages, the positioning from central banks, the technical breakouts we're witnessing, it all points to something that most people are going to miss until it's too late. Let me paint you a picture of what's actually happening right now. Gold just posted its strongest annual performance since the late 70s. We're talking about a gain that has major institutions scrambling to revise their forecasts upward. And here's the thing that should make your ears perk up. This isn't some speculative bubble driven by retail investors chasing momentum. This is institutional money, sovereign wealth funds, and central banks positioning themselves for what they see coming down the pipeline. The major brokerages are now openly discussing targets that would have gotten you laughed out of the room just a few years ago. We're seeing serious analysts at firms that manage trillions of dollars putting out research notes talking about gold potentially reaching levels that represent more than double where we are right now. Think about that for a second. These aren't gold bugs or conspiracy theorists. These are the same conservative institutions that have historically been skeptical of precious metals. But here's where it gets really interesting. The mechanics driving this move are completely different from what we saw in previous bull markets. Back in the late 70s, early 80s, gold's massive run was primarily driven by inflation fears and a collapsing dollar. In the 2008 financial crisis, it was about safe haven demand during a banking meltdown. What we're seeing now is a structural shift in how the global financial system operates, and gold is sitting right at the center of it. Central banks have been net buyers of gold for over a decade now, but the pace of accumulation has accelerated dramatically. We're not talking about small purchases to diversify reserves. We're talking about systematic, aggressive buying programs that suggest these institutions know something the general public hasn't figured out yet. When you see countries that have historically held minimal gold reserves suddenly ramping up purchases, when you see nations that were sellers becoming buyers, that's not random. That's strategic positioning. And before we go any further, I want to make sure you have access to something I put together. There's a free guide in the description that breaks down the saving secrets thousands of American retirees are using right now to protect their hard-earned wealth. It's completely free, and if you're concerned about what's happening in the markets, it's worth checking out. All right, let's keep going. The technical picture is telling us something remarkable. Gold has broken through resistance levels that held for years. These aren't minor breakouts that could reverse on a dime. These are decisive moves above levels that represented major psychological and technical barriers. When you see that kind of price action combined with the fundamental drivers we're witnessing, it creates a setup that historically has led to sustained bull markets. But let's talk about what's really driving this, because understanding the why is crucial to understanding where this goes next. The first major factor is the shift in monetary policy expectations. For years, we lived in a world where central banks could raise interest rates to combat inflation without worrying too much about breaking the economy. That playbook is getting thrown out the window. The debt levels across developed economies have reached a point where aggressive rate hikes create more problems than they solve. And when central banks are forced to choose between fighting inflation and preventing a debt crisis, history shows us which one they pick every single time. The second factor is the geopolitical restructuring that's happening right before our eyes. The dollar's role as the global reserve currency isn't being challenged by some new currency or digital token. It's being challenged by a return to the oldest form of money humanity has ever known. When you see major economies settling trade in their own currencies, when you see bilateral agreements that bypass the dollar entirely, when you see central banks building gold reserves while reducing dollar holdings, that's not a temporary trend. That's a fundamental shift in the architecture of global finance. Think about what happened when the Bretton Woods system collapsed. Gold went from being fixed at a certain price per ounce to trading freely in the market. The result was a move that made early holders generational wealth. We're not in the exact same situation now, but we are in a period where the rules of the game are being rewritten, and every time that happens in history, gold has been the asset that preserves purchasing power while everything else gets repriced. The supply and demand dynamics are creating a pressure cooker situation that most people aren't paying attention to. Gold mining production has been essentially flat for years. The easy deposits have been mined, the ore grades are declining, the costs of extraction are rising. Meanwhile, demand from every sector is increasing. Industrial demand for gold in electronics and technology continues to grow. Jewelry demand in emerging markets remains strong. Investment demand through ETFs and physical purchases is accelerating. And on top of all that, you have central bank buying that's running at levels we haven't seen in decades. When you have flat supply and rising demand, basic economics tells you what happens to price. But here's the kicker. A significant portion of the gold market isn't even physical gold. It's paper contracts, derivatives, and financial instruments that represent claims on gold that may or may not actually exist in a vault somewhere. The ratio of paper gold to physical gold has reached levels that create systemic risk. What happens when holders of those paper contracts decide they want actual metal? What happens when the music stops and there aren't enough chairs? We've seen glimpses of this dynamic play out in smaller markets. When physical demand spikes and paper holders try to take delivery, premiums explode. Delivery delays extend. The spread between paper prices and physical prices widens. Now imagine that happening on a global scale with institutional players involved. The potential for a squeeze in the physical market is something that keeps risk managers at major banks up at night. Let's talk about what this means for different types of investors, because the implications vary depending on your situation. If you're someone who's been sitting on gold for years, watching it grind higher while your friends made money in tech stocks and crypto, you're finally entering the phase where patience pays off. The early stages of a bull market are always the hardest because you're fighting against the prevailing narrative. Everyone thinks you're crazy for holding a barbarous relic when there are so many exciting growth opportunities. But when the tide turns, when the macro environment shifts in favor of hard assets, that's when the real gains happen. For people who are just starting to pay attention to gold now, the question is always the same. Am I too late? And the honest answer based on historical precedent is that major bull markets in gold don't end with a whimper. They end with a bang. They end with mainstream media coverage, with retail investors piling in, with premiums on physical metal going through the roof. We're not there yet, not even close. The average person on the street still thinks gold is boring. They still don't understand why anyone would own it. That's actually a bullish sign, because it means we're still in the early to middle stages of this move. The institutional positioning data tells a fascinating story. Large speculators, the hedge funds and trading firms that move markets, have been building long positions in gold futures, but their positioning isn't at extreme levels yet. There's still room for more money to flow into the market. Commercial traders, the producers, and industrial users who typically hedge their exposure are positioned in a way that suggests they expect higher prices ahead. When you see that kind of alignment between different types of market participants, it's worth paying attention to. Now, if you're sitting on retirement accounts and you're wondering how to position for what's coming, let me mention something important. If you have over $100,000 in retirement savings, there are strategies available that let you get exposure to physical gold inside those accounts without triggering tax penalties. I put together a comprehensive guide on how gold IRAs work, and it's in the description below. It covers the mechanics, the rules, the potential benefits of having physical precious metals as part of your retirement strategy. With everything we're seeing in the markets right now, with the geopolitical tensions, with the monetary policy uncertainty, having a hedge in place isn't just smart, it's essential. Check out that guide if this is relevant to your situation. All right, let's get back to where this market is headed. The correlation between gold and other asset classes is shifting in ways that have major implications for portfolio construction. Traditionally, gold has been negatively correlated with stocks during crisis periods. When equities crash, gold rallies as a safe haven. But we're starting to see periods where both assets move higher together. That's unusual, and it suggests that the driver isn't just fear. It's a broader concern about currency debasement and the long-term stability of fiat money. Bond markets are sending signals that are impossible to ignore. Real yields, the return you get on government bonds after accounting for inflation, have been negative or barely positive for extended periods. When you can't get a real return from supposedly risk-free government debt, where do you go? You go to assets that can't be printed, that can't be debased, that have maintained purchasing power across centuries. Gold fits that description perfectly. The currency markets are telling their own story. The dollar has been strong relative to other fiat currencies, but that strength is masking underlying weakness. When you measure the dollar against gold instead of against other paper currencies, the picture looks very different. The dollar has lost purchasing power measured in gold terms, and that trend is accelerating. Other major currencies are in even worse shape. The euro, the yen, the pound, they're all losing ground against gold. That's not a coincidence. That's a reflection of the fact that central banks around the world are trapped in the same policy box, and the only way out involves more money printing. Let's talk about the historical parallels, because understanding what happened in previous gold bull markets gives us a roadmap for what might happen next. In the 1970s, gold went from being fixed at a certain price to trading freely after the collapse of Bretton Woods. The initial move higher was met with skepticism. People thought it was a temporary spike. But as inflation accelerated, as confidence in the dollar eroded, as geopolitical tensions rose, gold went on a run that saw it multiply many times over. The people who bought early and held through the volatility made life-changing returns. In the 2000s, gold started its bull market when it was still under $300 per ounce. Most investors ignored it. They were too busy making money in real estate and stocks. But as the housing bubble inflated, as debt levels soared, as the seeds of the financial crisis were being planted, gold quietly climbed higher. By the time the crisis hit, gold was already well into its bull market. And when Lehman Brothers collapsed, when the banking system froze, when central banks started printing money on an unprecedented scale, gold went parabolic. The people who recognized the setup early were positioned perfectly. We're in a similar setup now, but the scale is bigger, the debt levels are higher, the geopolitical tensions are more complex, the monetary policy challenges are more severe, and the potential for gold to reprice higher is correspondingly larger. When major brokerages start talking about gold potentially reaching levels that represent multiples of the current price, they're not being sensational. They're looking at the same historical patterns, the same fundamental drivers, the same technical setups that preceded previous major moves. The mining sector is providing its own set of signals. Gold mining stocks have historically been a leveraged play on the gold price. When gold moves higher, mining stocks tend to move even higher because their profit margins expand dramatically. But right now, many quality mining companies are trading at valuations that don't reflect the current gold price, let alone where gold might be headed. That disconnect creates opportunity for investors who understand the sector. It also tells you that the broader market hasn't fully priced in the bull case for gold yet. The physical market dynamics are creating situations that would have been unthinkable a few years ago. Premiums on physical gold coins and bars have been elevated for extended periods. Delivery times from major mints have stretched out. Retail demand for physical metal has remained strong even as prices have climbed. That's unusual behavior. Typically, when prices rise, retail buyers step back and wait for a pullback. The fact that they're continuing to buy into strength suggests a level of concern about the financial system that goes beyond normal market cycles. Central bank gold purchases deserve a deeper look because the scale and persistence of the buying is unprecedented in modern times. We're not just talking about traditional gold-holding nations adding to reserves. We're seeing countries that historically held minimal gold making substantial purchases. We're seeing central banks that were net sellers in previous decades becoming aggressive buyers. The official data shows hundreds of tons of gold being purchased annually, but many analysts believe the actual numbers are higher because not all purchases are reported immediately. Why would central banks be buying gold so aggressively? They have access to the best economic data, the best forecasting models, the best intelligence about what's happening in the global financial system. If they're moving into gold in size, it's because they see risks that aren't being priced into other markets. They see the end game of the current monetary system. They see the need to have assets that aren't someone else's liability. They see gold as insurance against scenarios that most people aren't even considering yet. The geopolitical dimension of this story is crucial. We're watching the emergence of a multipolar world where the dollar's dominance is being challenged not through direct confrontation, but through gradual diversification. Major economies are building alternative payment systems. They're settling trade in local currencies. They're reducing their dollar reserves and increasing their gold holdings. This isn't happening overnight, but the trend is clear and it's accelerating. When you combine the monetary policy challenges, the geopolitical shifts, the supply and demand dynamics, and the technical breakouts we're seeing, you get a setup that historically has led to sustained bull markets in gold. The question isn't whether gold goes higher from here. The question is how high it goes and how long the move lasts. Based on the fundamental drivers in place, based on the historical precedents, based on the institutional positioning, we could be in the early stages of a move that makes previous bull markets look small by comparison. The implications for wealth preservation are profound. If you're someone who's spent decades building up retirement savings, who's worked hard to accumulate assets, who's trying to make sure your purchasing power is protected, gold represents a form of insurance that becomes more valuable as the risks in the system increase. It's not about getting rich quick. It's about making sure that when the dust settles from whatever economic and geopolitical turbulence lies ahead, you still have wealth that holds its value. The technical picture continues to improve. Gold has broken above major resistance levels and is holding those gains. The moving averages are aligned in a bullish configuration. The momentum indicators are showing strength without being overextended. The volume patterns suggest institutional accumulation rather than retail speculation. All of these technical factors support the fundamental case for higher prices ahead. One of the most compelling aspects of the current setup is the lack of euphoria. In the final stages of bull markets, you see excessive optimism, you see retail investors piling in, you see media coverage that borders on hysteria. We're not there yet. Most people still don't own gold. Most financial advisors still recommend minimal or zero allocation to precious metals. Most retirement portfolios have no exposure to physical gold. That tells you we're not at the end of this move. We're somewhere in the middle, which means there's still significant upside potential. The role of gold in a diversified portfolio is being reassessed by institutional investors. For years, the conventional wisdom was that gold was a small, optional allocation that you might include for diversification, but wasn't essential. That thinking is changing. As correlations between traditional asset classes increase, as the risk of simultaneous declines in stocks and bonds becomes more real, as currency debasement accelerates, gold's role as a true diversifier becomes more important. We're seeing pension funds, endowments, and sovereign wealth funds increase their gold allocations, not as a speculation, but as a strategic necessity. The supply side of the equation is often overlooked, but it's critical to understanding where prices go from here. Gold mining is a capital-intensive, long-led time business. It takes years to bring a new mine into production. The easy deposits have been found and mined. The remaining deposits are deeper, lower grade, and more expensive to extract. Environmental regulations are getting stricter. Permitting processes are getting longer. All of these factors constrain supply growth even as demand increases. That supply-demand imbalance has to resolve through higher prices. The paper gold market, the futures and derivatives that trade on exchanges, represents a multiple of the physical gold that actually exists. This creates a situation where the price discovery mechanism is based more on financial flows than on physical supply and demand. But there are limits to how far paper prices can diverge from physical reality. When physical demand spikes, when delivery requests increase, when the holders of paper contracts decide they want actual metal, the system gets stressed. We've seen this happen in smaller markets. The potential for it to happen in gold on a larger scale is a risk that's not being adequately priced in. Looking at the broader macro environment, we're in a period of unprecedented monetary and fiscal experimentation. Central banks have expanded their balance sheets to levels that would have been considered impossible a generation ago. Governments are running deficits that have no historical precedent in peacetime. The debt to GDP ratios across developed economies are at levels that historically have led to either default or inflation. Gold thrives in that kind of environment because it's the one asset that can't be printed, that can't be debased, that maintains its purchasing power when confidence in fiat currencies erodes. The investment case for gold isn't based on a single factor. It's based on a convergence of multiple trends that are all pointing in the same direction. Monetary policy that favors hard assets, geopolitical shifts that undermine the dollar's dominance, supply constraints that limit production growth, demand increases from every sector, technical breakouts that suggest a major trend change, institutional positioning that indicates smart money is accumulating. When you see all of these factors aligning, when you see the setup that's in place right now, it becomes clear why gold holders are entering what could be the most profitable phase of this entire cycle. For those of you who've stuck with me this far, who've taken the time to understand what's really happening in the gold market, I want to make sure you have access to the resources that can help you take action. That free guide I mentioned earlier, the one in the description, it's not just theory. It's practical information on how to position your retirement savings to benefit from what's coming. And here's something special. If you're an American retiree with at least $100,000 in any retirement account, and you mention that you watch this video all the way through, you'll get access to an exclusive one-on-one educational web conference. No obligation, no pressure, just a chance to get personalized guidance on how to protect your wealth in the current environment. That offer is only available to people who make it to the end of this video. So if that's you, check the description and take advantage of it. The bottom line is this. Gold holders are entering a phase where patience is about to be rewarded. The setup is in place. The fundamentals are aligned. The technicals are confirming. The institutional money is positioning. The central banks are buying. The supply-demand dynamics are tightening. Everything that needs to be in place for a sustained bull market is there. The question is whether you're positioned to benefit from it. Whether you've been holding gold for years or you're just starting to pay attention now, understanding what's happening and why it's happening is the first step. Taking action to protect and grow your wealth is the next one. The winning zone isn't just a catchy phrase. It's a description of where we are in this cycle. And for those who recognize it and act on it, the potential rewards are substantial.